From a fixed income market outlook point of view, there will be two major factors beside the performance of fixed income as an asset class. One obviously is what happens to US interest rates, because if US starts to reduce their interest rates more aggressively than what is expected, RBI will also have to follow suit. There is no way that Indian interest rates will remain much higher than US for too long, because it's not conducive to balance of payment at all. So if US starts to cut aggressively, RBI will also follow, and that essentially means that you will see a windfall capital gain from the bond markets. If you're holding any long-term government bond or any long-term corporate bond, either directly or through mutual funds, you'll probably end up seeing double-digit rate of return on that. It's not the base case that we are expecting. I think what we will see is probably one more year of steady interest rates, one more year of accrual income. So you will typically see fixed income markets at a very steady rate of approximately 7 to 8%, both from a coupon point of view as well as a capital appreciation point of view. I do not expect any major credit crisis this time. The banking and NBFC NPAs are much under control. RBI has cleaned up the cooperative banking side also over the last 5 years. So there is no major credit offtake crisis kind of sitting on the anvil. The credit offtake on the other hand is very strong. We're still growing at a very healthy rate of credit growth. But I don't see that creating a bubble and a consequent fall in the macro structures. So fixed income, given the basis of US being steady interest rates and Indian inflation being constant, I think we'll see one more year of accrual income largely on the fixed income portfolio side. If at all RBI will cut interest rates, that will be on the back of the Fed cutting rates. Otherwise, I think the need for RBI to cut rates from a macro point of view will only come from 2025 calendar year, and that too, my sense would be it will happen in the second half of 2025. So till then, I think it will be accrual income that you will get. It makes a lot of sense to invest in long duration bonds and long duration good quality papers, either directly or through mutual funds, because over a 5-year cycle, if you start from now, my sense is you'll probably get about 8-9% compounded yield, considering the capital appreciation that you will get towards the second half of a 5-year cycle. One of the things I mentioned in the 2023 review video was the extreme lack of volatility on the dollar rupee as a currency pair. If you look at the chart of dollar rupee, you will see that it has been stuck in a range for quite some time now. It is unprecedented. We normally don't see that happening, even despite how the US dollar has actually weakened against all major currencies. We should have seen rupee appreciating against dollar by now, but what you have seen is RBI purchasing dollars aggressively. Over the last 6 months, the amount of dollars that is purchased by RBI is so high that rupee has actually been supported due to that. In 2024, with the base case that we expect that the interest rates are going to be constant, you will see dollar rupee again in a narrow range with slight appreciation pressure on rupee, because at some point in time, the US weakness data will come out. If there is no hard landing, even if there is a soft landing, you will see some of the resilience of US macro falling, and dollar as a currency will continue to weaken. It's already started. It will continue to weaken. If Reserve Bank of India decides that we don't want too much reserves beyond a point, it will stop buying the excess dollars coming into the market, which essentially means rupee will appreciate. I will not be surprised if you will see the net impact of dollar rupee over the year being rupee positive. RBI actually has one more tool now from a liquidity management point of view. If rupee starts to appreciate and if there is a need to create domestic liquidity, RBI can actually start purchasing excess dollars. It reserves that tool like it did this year also. So it can kind of use it for both dollar rupee management as well as domestic liquidity management. It's going to be a very potent tool. They've used it this year twice. If they use it next year also, they can continue to keep dollar rupee stable at this 82, 83, 84 band. But if Reserve Bank of India decides that, we don't need so much domestic liquidity, it can let rupee appreciate. That is when you'll probably see some net appreciation. One major factor that is going to impact both government bonds as well as dollar rupee is the fact that this year is when you will see the inclusion of Indian government bonds in the JP Morgan Emerging Market Index. When that happens, all the global investors who invest in fixed income through indices we call them index huggers. So whichever index JP Morgan puts out, there are a lot of global investors who jump onto it. Purely by the virtue of that inclusion, you will expect to see about $15 to $20 billion of inflows through government bonds in India annually. So over the next 3 to 4 years, you'll see about $40-50 billion coming in. That is going to be very, very positive for balance of payment. One more reason why rupee will be supported. So notwithstanding dollar rupee purchase by RBI, I think it will be a net appreciating year for rupee. Coming to the most favorite market for most, which is equity, it is going to be one more good year is what I would expect. There are a lot of strong tailwinds which is coming in the equity market. I already mentioned about the macro being strong. I already mentioned about interest rates hopefully continuing to remain stable. I also think that US probably will not do a hard landing this year at least. So given all this, I think there is continuation of what could be the bull market run in equity. What you will obviously see is logically what happens every time sector rotation will happen. There will be a change in direction of whether you will go with, let's say, a large cap component in your portfolio or a mid cap. Those changes will happen. In fact, if you see 2023, the biggest rally has been in mid cap and small cap. Nifty was not really the biggest component of the market. But if you start seeing markets since December, Nifty has already started making a comeback. So the underperformance of Nifty to mid cap and small cap is already coming kind of lower as we speak. So that trend may continue. I think if I were to bet on equity going forward, I would rather be on the large cap side rather than putting all my money on mid cap and small cap. Within that, I think sector rotation is going to happen. So probably sectors that did not do well over the last few years, you will see some money coming back on that. Banking is looking extremely positive. Very low NPAs, very high credit offtake, interest rates stable to probably going down in the next cycle. I think banking is going to be a very interesting cycle in itself. There are two important pillars on which the equity market rally is happening. One is the retail participation in Indian equity, both through mutual fund SIPs, which are at record highs as we speak, and also through direct equity participation that we see. Despite the foreign investors not investing significantly over the past couple of years, we have seen equity market being supported by the domestic investors. If that trend continues, that's a huge positive for the Indian equity market. The higher the retail participation, more reliance on that domestic money to keep the equity rally going on. The second strong pillar, which I think will continue, is corporate earnings. The last 4 years compounded annualized growth rate of Nifty earnings per share is 21%. Even if you expect it to moderate a little bit because of a higher growth, you'll probably still expect it to be at 15-16%. That's a very strong EPS growth. So with very strong EPS growth, with very strong liquidity, there is very less reasons for the markets to crash unless, as I mentioned earlier also, for some geopolitical or some black swan event that we are not able to see coming at this point. If it happens, of course, there will be moderation. Union election is obviously one known event. If there is a BJP or if there's a result which is not pro-BJP, then again you will see some market volatility. What is going to be very interesting in equity going forward is the sector rotation piece. So that's where there's a lot of money to be made. So if you can pick the right sectors for the next 5 years, banking is, for example, one example that I would want to bet on. There are a few others which could be very interesting. That's where you can actually still make a lot of money by doing quality stock picking or quality sector allocation rather than just riding the wave that you've seen in the last few years. Typically, if you see how investing works, the same asset class does not continue to do well every time. You will have to kind of ensure that the portfolio is reasonably well diversified for that. So if you are sitting on a lot of gains already from the last few years, 2024 is when you would want to hope for some preservation of capital, look for some low risk investment, probably like large cap rather than putting all your money in mid cap and small cap. So in summary, I think it's going to be one more good year for equity. I would be very surprised if you see a major crash in equity unless it is coming from some factor which is a black swan or a unknown event that we are not aware of.